Hi, welcome to the next edition of War in the Markets. Yesterday's market was showing a bounce back because there was some amount of relief expected in the war situation with the ceasefire proposal. So I thought I will wait till the President Trump press conference, which took place late last night, and then the 5:30 a.m. India time, the deadline for Trump to attack. Well, both the events have passed and nothing much has happened. And if you look at the macro indicators, oil continues to be at around 109, 110, dollar index is around 100, Indian rupee is trading at around 93 on the spot. But if you take the forward premia, it's showing a literally 97 level at the end of 1 year. So weakening trend, and the Indian G6 are also trading at 7% plus. So none of the macro indicators has changed. What about the FII selling? Well, nothing special. They have been selling at about 8 to 9,000 crores every day from in April, and yesterday was the same. And yesterday, in fact, DIS matched the FIIs with around 8,000 crores as buys. So, if you're seeing this, then it looks like one very important conclusion that we need to draw is that finally the market, especially the Indian market, has come to terms with the war. What do I mean by this? If you go back into the Russia-Ukraine crisis also, the war is still going on, but the market stabilized in about 90 to 120 days after a sharp correction and then traded there. And then it took new cues from the domestic front or whatever to take the next direction. So this war has been short and sweet in terms of the fact that, like the Russia-Ukraine war, the war may continue for some time. It's clear that it's not near an end because the ceasefire proposal has been rejected by both Mr. Trump and the Iranian side. And he's saying all hell will break loose today or tomorrow. But if you look at the financial markets, right, they are not showing. They are so now they have discounted that price of oil, and for the oil to go back above now 120, 130, 140 as it is in the Russia-Ukraine war, will need a severe damage on the escalation of the war on the oil fields or whatever, right? So that risk remains for the markets. But if you take that aside, all the rest, and in the volatility index, I forgot to mention that, that's also hovering around 25. So if you look at all these indicators, they are all not positive in India, but still the markets are positive. Why was that? And this is the pattern I've been seeing for the past few days, and which I expect to continue, which is that because of the high volatility index, the premium level for the trading, right, for F&O has shot up. Second, from April 1st, we are seeing the the new ST tax is coming to play. So it's costly to trade. So what you're going to see is going to be a range bound. And so in terms of the put call ratio, yesterday, for example, it's shifted in favor of the bulls, right? Went above 1. So, but there is still a massive buildup of shorts of FIS in the system because there are short-term traders who seek to take advantage of that. So, market's direction, what I've been seeing is that the market starts up with a gap up because all this news overnight gets absorbed, and so the people who are shorting the market rush to cover it. And then sometime during the day, the stabilization takes place. In the evening, again based on the news flow, fresh shorts get built up and the market seems to fizzle away. A broad trend, I'm not saying that it will happen every day this way, but one of the important conclusions to draw from here is that there is an exhaustion in the market on this Trump-induced volatility and the war. Yes, oil is at 100. It will hurt India's inflation fiscal deficit to some extent, and APS growth to some extent, GDP growth. All of that is fine. It's been absorbed. The market is corrected and absorbed it. So I have a feeling that we are about close to the bottom of the market. Now from a 23,000 level, it will be range bound plus or minus, let's say 500. Now can the market touch 22,000 or lower? It can, like I said, if there's a hit to an energy plant. Either Iran hits something very energy plant in the Saudi or UAE, Kuwait side, or America or Israel hit something, right? So any damage and destruction to the supply side of oil more than what's already happened will definitely take oil to a next higher level, and market has not discounted a 140 oil yet. So that risk remains. But taking that into account, right, all the rest of the bad news is already there. We have a weakening rupee, a strong dollar, You have the interest rates have going up over 7. So the market now, with all of this information already in the price, I think that's important, will now shift to assessing the value of the Indian economy stock markets, because full clarity in terms of understanding the impact of the oil, all that will be happening as we speak. But two important events are probably more important, which is the RBI policy tomorrow, because there is this little bit of nervousness at the same time and confidence on the RBI that in a situation where the country is facing the challenge of imported inflation, that RBI, how will they react? Now, imported inflation can't be controlled through rate hikes. So the small camp that is in favor of rate hikes, I'm not in that camp. Now, obviously, doing a rate cut at a time of inflation is not good, because demand side inflation will come and increase the supply side inflation, make it worse. So clearly, RBI's hands are tied. But what the RBI can do outside of the policy, how do they project the inflation data for the next year? How do they project the GDP growth? These are interesting things from the very important policy tomorrow. And if they come out with saying we are ready to support, right, I think that's the big news which the market will wait for. So despite no change on the rates front, and maybe even no change on the accommodation policy or the withdrawal of accommodation policy, no change, the language of the RBI, what they say, will be very important. So market will be for more immediate for today and tomorrow till the policy focus on that. Now once that event is behind us, the focus will be on the domestic earnings factor, because they'll now want to know from the companies, okay, how big has been the damage for the month of March because of the war? And what's the guidance forward? How are you planning it? What's it? And based on which the 2026-27 EPS forward will get calculated. And then the market will get a sense of what should the 1 year forward PE look like in the context of the revised earnings guidance. And then is the levels of the market overvalued or undervalued related to that. And this is an action driven both by DIIs and FIIs. But from an FII perspective, they will continue to remain net sellers for quite some time, because for them these macro factors matter a lot more, because it's a relative to other countries. Valuation is relative to other countries. Impact of oil is far worse for India compared to other countries. Rupee weakening is far worsening compared to other countries. So they will continue to be nervous, but I expect that the current levels of 8 to 10,000 crores of sales is what they will continue to be selling. No significant, of course, that oil 140, that remember that. But DIS, with the earnings season on board, will be stepping in and evaluating all these parameters and starting to buy little by little, because they've already used a lot of the cash hold. So if they want to buy the right sectors, we'll get to know in 2 days' time how the mutual fund inflows have been, to know the continuing 30,000 is like pre-book and there's some lump sum flows or not, or people panicking. We'll know that and just wait for a couple of days. But the fact is that when they see a sector which has absorbed the oil impact well and is looking at a good guidance, they will want to buy that. So they will want to sell something. So DIs will continue to provide strong support against the FII selling. They will try to reduce the volatility, but the volatility index will continue to remain around the 25 levels. I don't expect significant change there. But this whole process of sector rotation will be there, and hence market will be range bound. But then that's the ideal situation for long-term investors to now continue the strategy of that 1% accumulation through this phase. We're not going to see, if you're a little more risk, then you can make that 1% to 1.25. But I think that barring an attack on the oil refinery itself, oil storage plant itself, the war impact has been discounted to the markets. So it's a good time to rebuild your portfolio with that gradual accumulation. Don't try to guess the sectors which will do well. The earnings season only will tell us. Either you diversify as you did before the war, or you continue to give it to a mutual fund who will diversify on your behalf. So I think that's the kind of, I would say, a feeling of relief that despite these two big events of Trump escalating this morning, or, nothing has happened to the markets. So I think that should give you confidence from a long-term investment perspective.